Microsoft stock is down 25% from its all-time high. Investors are fearful as the company increases spending to build AI data centers. But I think the market is getting this one completely wrong, and I'm actively buying Microsoft stock right now in my own portfolio. Today I'm breaking down the massive opportunity in Microsoft stock after the crash, and I'll reveal the exact price I'm willing to pay for Microsoft stock towards the end. Since 2026 began, Microsoft stock is down roughly 12%. Significant underperformance when compared to the S&P 500 index, which is up over 7% in the same period. This divergence was caused by one specific number in Microsoft's financials. On January 28th, Microsoft reported their fiscal Q2 earnings. The company beat Wall Street's estimates for revenue and earnings per share, but came in with higher than expected capital expenditures. This sent the stock down 10% from $480 to $430 per share. Capital expenditures, or Capex, is the money invested by the company to purchase, improve, or maintain long-term physical assets such as property, buildings, or equipment to grow or maintain a business. In Microsoft's case, they're increasing Capex at an extraordinary rate, and the market does not like it. As shown on this chart, Microsoft's quarterly Capex spend has gone from $2 billion back in 2016 to $30 billion in 2026. That's a 15x or 1400% increase in spending. And you can see that their Capex is still increasing at an exponential rate with no signs of slowing down. Most of this Capex is spent to build new data centers for Microsoft's cloud computing business, Azure. In their latest earnings release on April 29th, Microsoft reported Azure revenue growth of 40%. Which they said was ahead of guidance, and their overall intelligent cloud segment grew revenue to $34.7 billion, up 30% year over year. But this wasn't enough to turn Microsoft stock around, as the stock fell again from $425 to around $415 per share. The market was more impressed by Microsoft's competitors, Alphabet and Amazon. Amazon Web Services, which is Amazon's cloud division, grew revenue to $37.6 billion, up 28% year over year, maintaining its position as the market leader. But here comes the star of the show. Alphabet, whose Google Cloud platform is the third largest player in the industry, grew cloud revenue to $20 billion, up a whopping 63% year over year. So despite being only half the size of Microsoft and Amazon's cloud business, Alphabet's increasing growth rate excited the market. But despite investor fears around Microsoft's Capex spending, I'm actively buying the stock in my own portfolio. So I'm going to tell you the 3 biggest reasons why Microsoft stock is a buy right now, and then I'll show you my exact valuation model. First, Microsoft is possibly the widest moat company in the world. Its fundamentals are a textbook example of a compounding machine. They're deeply embedded in consumer computing with their Windows operating system, which is the foundation for their entire business model. From this foundation, they have their Microsoft 365 consumer subscription. This gives users access to the well-known suite of apps like Excel, Word, PowerPoint, and many more. 365 Consumer recently reached 95 million paid subscribers, up 7% year over year. But total Microsoft 365 Consumer revenue grew a massive 33%, led by ARPU growth. ARPU is average revenue per user. Microsoft are basically saying that subscribers grew at 7%, but we have so much pricing power that ARPU grew by 26%. That's how total 365 consumer revenue grew 33% in the quarter. Microsoft's company-wide pricing power can be seen when we look at their operating margin. Over the past 10 years, they've gone from around a 30% operating margin up to a market-leading 45%. Pricing power is one of the most powerful forces in business. This is because price increases, especially in software businesses, come with little to no additional cost. Therefore, all the extra revenue from the price increases becomes pure profit. That's why operating margins expand. But 365 Consumer is only scratching the surface of Microsoft's software empire. Their 365 Commercial business generates roughly 10 times more revenue than the consumer version. 365 Commercial includes all of the features in 365 Consumer like Excel, Word, and PowerPoint, but also includes enterprise-grade identity, security, compliance, device management, automation, and collaboration infrastructure. Basically anything a big business would need to operate in the modern economy. 365 Commercial becomes deeply embedded in employee workflows, making switching to a competitor very difficult. That stickiness means very few customers ever leave the Microsoft ecosystem. Not only does this mean pricing power, but more importantly, in an ever-evolving business landscape, Microsoft has the opportunity to upsell, offering new and improved products and services to the same customers, embedding their software even deeper into the customer's operations, making Microsoft 365 Commercial the mission-critical operating system for enterprise across the globe. 365 Commercial makes up roughly 75% of Microsoft's productivity and business processes segment, which produced $35 billion in revenue last quarter. 365 Commercial grew revenue 19% year over year, ahead of expectations. Paid commercial seats grew 6%, led by small medium businesses and frontline offerings. ARPU growth driven by E5 and M365 Copilot with accelerating Copilot seat adds. This is a crucial insight into Microsoft's AI performance. Despite bearish headlines suggesting Microsoft can't monetize AI, the company itself is saying the complete opposite, with accelerating Copilot seat adds. Copilot is Microsoft's AI assistant, which it's integrating across all of its software touchpoints, and enterprises are clearly willing to pay top dollar to access it. Copilot is a good example of Microsoft's ability to upsell new products to their existing commercial customer base. This leads nicely into my second reason why Microsoft stock is a buy right now: Microsoft Azure's AI Tailwind. Azure is Microsoft's cloud computing division, which is included in their intelligent cloud revenue segment that produced $34.7 billion last quarter, up 30% year over year. Cloud computing is a secular tailwind for Microsoft, basically a long-term structural trend that will benefit the company over the coming decades. Cloud computing is the on-demand delivery of IT resources, such as servers, storage, databases, and software, over the internet with a pay-as-you-go pricing model. In the past, businesses used to buy and maintain their own IT infrastructure, but now businesses can access these IT services on an as-need basis from cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud. The cloud computing market is expected to grow from around $1.1 trillion in 2026 to $3.3 trillion by 2033. This is what the whole AI arms race is all about. Companies like Alphabet, Amazon, Microsoft, and Oracle all want to grab their piece of the pie before it's too late. And you might be thinking, it's growing fast, but is it profitable? The answer is quite shocking. Microsoft doesn't report operating margins specifically for its cloud segment. However, Alphabet announced their Google Cloud operating margin hit 32.9% in their last quarterly report, and the market leader, Amazon, reported their AWS operating margin at a whopping 37.7%. These huge profit margins are how the big three hyperscalers justify their massive Capex commitments. As you can see from this chart, the big three, Microsoft, Alphabet, and Amazon, spent $358 billion in Capex during the past 12 months alone. And this number is only expected to rise over the coming years as the current supply of cloud computing struggles to meet demand. The next reason why Microsoft stock is a buy right now will probably surprise you the most. We're going to look at Microsoft's current valuation. I'm going to show you why Microsoft stock is deeply undervalued. Firstly, if we compare the hyperscalers on a price to earnings basis, over the past year, Microsoft went from being the most highly rated of the three to the most lowly rated, going from a 34 PE ratio 1 year ago to a 25 PE today. That's a 26% decline in valuation multiple alone. Despite this huge valuation compression, Microsoft stock fell only 5% over the same time period because its earnings per share grew 30% in the last 12 months. Over the same 1 year period, Alphabet's PE ratio expanded from a ridiculously low 17 PE to a 30 PE ratio today, whilst Amazon's PE ratio is unchanged from 1 year ago. So there's a clear divergence here. For some reason, the market is punishing Microsoft with a lower valuation multiple than its peers. This seems especially ridiculous because Microsoft has by far the highest operating margin of the three businesses, which in normal market conditions would justify a premium valuation. If we look at Microsoft's PE ratio over the past 5 years, we can see that compared to its history, the valuation is being discounted. The stock usually trades at between 30 and 35 times earnings, suggesting the current 25 PE multiple has a lot of room for expansion. Next, we're going to head over to the DCF calculator on Qualtrim to find out the return that Microsoft stock could provide for investors if you were to buy at today's price. We have to come up with some assumptions for Microsoft's earnings per share growth rate over the next 5 years and an appropriate PE multiple for the stock to trade at. In terms of earnings per share, Microsoft is experiencing an increase in growth. Over the past 5 years, Microsoft's EPS grew at an 18% CAGR. However, EPS growth accelerated back up to 30% in the last 12 months. Very impressive. On these numbers alone, it's quite astonishing that the market has re-rated the stock downward. Microsoft's earnings per share growth averaged 29% over the past 10 years, which again is exceptional. As we discussed, the wider cloud computing market is expected to grow at a rapid pace. A 15 to 20% CAGR seems to be the minimum that analysts are willing to project. So for our valuation model, I'm going to assume that Microsoft can grow their earnings per share at a rate of 19% over the next 5 years. Then for its PE ratio, I expect Microsoft stock to be re-rated over the next few years. A 25 PE multiple is historically low for the modern day Microsoft machine. I don't see why the stock can't trade back up to around its 5-year median PE multiple. So for our valuation model, we're going to assume that Microsoft stock will trade at a 32 PE ratio. Based on these assumptions, you can expect Microsoft stock to increase from just under $425 to $1,220 per share over the next 5 years. That's a 3x increase, or just over 23% annualized returns. As one of the most predictable, high-margin big tech compounders, you'd have to say that Microsoft stock is the best risk-reward play in the stock market right now.